The day you retire should be one of the happiest days of your life. You've worked for decades. You've paid into the system. You've earned this. But what nobody warned you about, what your HR department never mentioned, what your financial advisor may have glossed right over, is that the IRS has a completely different set of rules waiting for you the moment you stop working. And in 2026, several of those rules have changed. If you don't know about them, they will cost you. Quietly, automatically, sometimes thousands of dollars in a single year. Stay with me, because what you're about to hear could protect your retirement, starting today. Welcome back. If you're new here, this channel is dedicated to one thing: making sure American seniors have the information they need to protect their money, their benefits, and their future. Today's topic is one I've been getting flooded with messages about. Retirees, people just like you, are being blindsided by IRS rules they never saw coming. So today, we're going to walk through all 10 of them. Plain English, no jargon, no confusion. Let's go. I want to tell you about a woman named Margaret from Ohio. Margaret retired in January, right on schedule at 66. She had her Social Security lined up. She had her savings. She thought she had everything figured out. By April, she owed the IRS over $3,400 she did not plan for. Not because she did anything wrong, but because she didn't know about 3 specific IRS rules that activate the moment your retirement begins. Margaret is not alone. Every single year, tens of thousands of seniors walk into retirement completely unaware of what the tax code has waiting for them. And here's what they're not telling you. The IRS doesn't send you a warning letter. They don't call you. They just send you the bill. So let's make sure you never get that bill. Now, before we jump in, let me be clear about something important. Everything I'm sharing with you today is based on IRS guidelines and Social Security Administration rules that are in effect for 2026. These are not rumors. These are not scare tactics. This is the actual tax code, and it affects millions of Americans who are retired or approaching retirement right now. Some of these rules are new updates for 2026. Some have been in place for years, but are tripping people up more than ever because of inflation adjustments and benefit increases that pushed more seniors into higher tax thresholds. All right, let's get into it. Rule number 1: your Social Security is taxable, more of it than you think. Let's start here because this one shocks people the most. Yes, your Social Security benefits can be taxed. Up to 85% of your benefits could be subject to federal income tax, depending on what the IRS calls your combined income. Here's how they calculate it. Take your adjusted gross income, add any non-taxable interest, then add half of your Social Security benefits. That total is your combined income. If you're a single filer and that number goes above $25,000, you're paying tax on your benefits. If you're married filing jointly and your combined income tops $34,000, up to 85% of your Social Security is taxable. Now here's the critical part. Those thresholds have not been adjusted for inflation in decades. So as benefits go up, more and more seniors are crossing those lines without realizing it. Rule number 2: required minimum distributions. Start at 73, and they're not optional. If you have a traditional IRA, a 401k, or most employer-sponsored retirement plans, the IRS requires you to start taking money out at age 73. These are called required minimum distributions, RMDs. Miss one, take out too little, or miscalculate. And the IRS can hit you with a penalty of up to 25% of the amount you should have withdrawn. And here's what they're not telling you. Those RMDs count as ordinary income. That means they can push you into a higher tax bracket, increase your Medicare premiums, and trigger more Social Security taxation all at once. It's a triple hit. Rule number 3: Medicare premiums can jump based on your income. This is called IRMAA. Most people don't know this exists until they're already paying it. IRMAA, the income-related monthly adjustment amount, means that if your income goes above certain levels, the government charges you more for your Medicare Part B and Part D premiums. In 2026, the standard Medicare Part B premium is already significant, But if your income from 2 years prior, that's your 2024 tax return, puts you above the threshold, you could be paying hundreds of dollars more per month. And because RMDs, rule number 2, count as income, they can trigger IRMAA. See how these rules stack on top of each other? Rule number 4, the tax withholding rules. Change when you retire. When you were working, your employer automatically withheld taxes from your paycheck. Simple, clean. The moment you retire, that automatic system stops. Now it's your responsibility to make quarterly estimated tax payments to the IRS, or have withholding taken from your Social Security and pension payments directly. If you don't do this, and millions of retirees don't, you could face an underpayment penalty when you file your return in April, plus interest. This catches people completely off guard in their first year of retirement. Rule number 5. The standard deduction is higher for seniors. Are you claiming it? Here's some good news, but only if you know about it. If you are 65 or older, the IRS gives you an additional standard deduction on top of the regular amount. For 2026, this extra amount is meaningful, and it reduces the income you're taxed on. If you're 65 or older and blind, you get an even higher deduction. But here's the problem. If someone is preparing your taxes and they don't know your age, or if you're using old tax software you haven't updated, you might be missing this. Check your return. Make sure that extra deduction is on there. Rule number 6, selling your home in retirement has tax consequences. Many seniors decide to downsize when they retire, sell the big house, move somewhere smaller, maybe somewhere warmer. The IRS allows you to exclude up to $250,000 in profit from the sale of your primary home, $500,000 if you're married, as long as you've lived there for at least 2 of the last 5 years. But here's what trips people up. Anything above that exclusion is taxable as a capital gain. And in 2026, if your income is above certain levels, you could face a 15% or even 20% capital gains tax on that excess profit. Plus, that home sale profit counts toward your combined income for that year, which can trigger rule number 1, more Social Security tax, and rule number 3, IRMAA surcharges. One big sale, multiple tax consequences. Plan ahead. Rule number 7, pension income is almost always fully taxable. If you receive a pension, whether from a private employer or a government job, almost all of it is taxable as ordinary income at the federal level. Some states don't tax pension income, but the federal government almost always does. This is income you need to plan for. It doesn't have automatic withholding unless you specifically request it, and many retirees don't know they need to ask. Call your pension administrator today if you're not sure, and ask whether federal income tax is being withheld from your monthly payment. Rule number 8, the 10% early withdrawal penalty. Know the exceptions. If you withdraw from your IRA or 401k before age 59, 1 or 2, the IRS normally charges a 10% penalty on top of regular income taxes. But, and this is important, there are exceptions many people don't know about. Qualified medical expenses, disability, certain distributions under what's called Rule 72T, first-time homebuyer expenses, limited, health insurance premiums if you're unemployed. If you're in a tough spot financially and you're thinking about tapping your retirement account early, talk to a tax professional first. You may qualify for a penalty exemption that saves you thousands. Rule number 9, inherited IRAs. Now have a 10-year rule. This affects your family. If you're planning to leave your IRA to your children or grandchildren, or if you've already inherited one, listen closely. Under rules that went into effect in recent years and are now fully enforced in 2026, most non-spouse beneficiaries must withdraw the entire inherited IRA within 10 years of the original owner's death. This means your children can't just let that money grow tax-free forever. They have to take it out and pay taxes on it within a decade. If they don't do it correctly, the IRS penalizes them. This is a planning conversation you need to have with your family now, not after you're gone. Rule number 10. The IRS has increased scrutiny on senior returns. Here's why. And finally, this one is important because the IRS has increased audit activity in recent years, And certain red flags on senior returns are getting more attention. Large charitable deductions, big Roth conversions, unusual home sale figures, mismatched income reporting between your 1099s and your return. In 2026, the IRS has more technology and more resources to cross-check your tax return against third-party data than ever before. The good news: if you're honest and you report everything correctly, you have nothing to worry about. The bad news: honest mistakes, like misreporting an RMD amount or forgetting to include a small pension, can still trigger notices, delays, or audits. Get a qualified tax professional who works specifically with retirees. It is worth every penny. Now I want to pause for just a moment. I know this is a lot, and I know how overwhelming it can feel when you've done everything right your whole life, and the system still feels like it's working against you. You are not imagining that. The tax code is complicated, and it is especially complicated for retirees. But here is what I want you to hold on to. Knowledge is protection. Every single rule I just walked you through, you can navigate it. You can plan around it. You can protect yourself from it. The people who get hurt are the ones who didn't know. And you are not one of those people anymore. So what should you actually do with all of this? Step 1. Review last year's tax return. Look specifically at how your Social Security was taxed and whether you claim the senior standard deduction. Step 2. Call your financial institution or pension administrator and confirm that proper tax withholding is set up on every income source you receive. Step 3. If you're approaching 73, talk to a financial advisor about your RMD strategy before the end of this year. Step 4. If you inherited an IRA in the last few years, confirm with a tax professional that you're on track with the 10-year withdrawal rule. Step 5. Work with a tax preparer who specializes in senior returns. Not a general preparer, someone who does this specifically. These 5 steps could literally save you thousands of dollars. Now, a lot of you have been asking about financial relief programs available to seniors in 2026. Here's what you need to know right now. If your income is limited, you may qualify for the IRS's Low-Income Taxpayer Clinic program, which provides free or low-cost tax help. The VITA program, Volunteer Income Tax Assistance, also offers free tax preparation for seniors with income below $67,000. Additionally, many states are expanding their property tax relief and circuit breaker programs for seniors in 2026, specifically because of rising home values and fixed incomes under pressure. Check with your state's Department of Revenue or your local area agency on aging to find out what programs are active in your area. And this part is critical. Some of these programs have application deadlines that come and go quietly. Don't miss them. Set a reminder. Ask a family member to help you look into it this week. For those of you collecting or approaching Social Security, here is your 2026 update. Social Security received a cost of living adjustment for 2026. That increase in your monthly check is good news, but it also means more of you will cross the combined income threshold that triggers benefit taxation for the first time. If you just got a slightly higher monthly payment this year, run those numbers. You may now owe federal taxes on a portion of your benefits for the first time ever. Also, if you're still working part-time while collecting Social Security before your full retirement age, the earnings limit applies. Earning above that limit means the SSA temporarily withholds some of your benefit. Once you hit full retirement age, that limit disappears. But before then, it's something you need to track carefully. And this could directly affect your next Social Security payment if you're not paying attention. The SSA and the IRS share data. They talk to each other, and adjustments can happen faster than you might expect. Stay informed. Stay ahead of it. I received a message last week from a viewer, Thomas, 70 from Florida, who wrote, "I had no idea my part-time consulting work after retirement would push me into a higher Medicare premium bracket. By the time I found out, I was already paying the surcharge. I wish I'd seen your video sooner." Thomas's situation is one of the most common we hear about, and it's completely preventable with the right information. That's why we're here. That's why you subscribed. And that's why I need you to share this video with every senior in your life who might need to hear it. Let me quickly bust a few myths that keep circulating online. Myth: Social Security is tax-free. Fact: For most seniors, up to 85% of it can be federally taxed depending on your total income. Myth: Once you're retired, you don't need to file taxes. Fact: If your income from any source exceeds the filing threshold, you are required to file. Myth: Roth IRA withdrawals are always tax-free. Fact: Qualified withdrawals are tax-free, but the rules around what qualifies matter. Mistakes happen. Myth: Medicare is free after 65. Fact: Part B has a premium, and IRMAA can make it significantly more expensive based on your income. Here's the reality of where we are right now. It's 2026. Inflation has changed the math. Benefit amounts have shifted. Income thresholds that were set decades ago are catching more seniors than ever. The window to adjust your withholding, plan your RMDs, and protect yourself from unnecessary tax bills is not unlimited. Some decisions, like adjusting your quarterly estimated taxes, need to happen before the IRS deadline. Don't wait until April. Don't wait until you get a notice. Take action now, while you still have time to course correct. If you're not sure where to start, here are 3 free resources you can access today. irs.gov/seniors. The IRS has a dedicated section for senior taxpayers with guides, publications, and free filing options. ssa.gov. For anything related to your Social Security record, benefit estimates, and earnings history. Benefits.gov. A government portal that can help you identify federal programs you may be eligible for based on your age and income. You don't need to figure this out alone. There is help available. I want to leave you with this. You have spent your life building something. You worked, you saved, you sacrificed. You showed up for your family, your community, and yes, for this country. You deserve to enjoy what you built. The IRS rules are real. The consequences are real. But so is your ability to navigate them, especially when you have the right information. Don't let rules you didn't know about take from you what you've earned. If this video helped you, even just a little, I need you to do 3 things for me right now. First, hit that like button. It tells the algorithm that real people need this information, and it helps us reach more seniors who might not know any of this. Second, subscribe if you haven't already. We release new updates on Social Security, IRS changes, Medicare, and financial relief programs every single week. Third, drop a comment below and tell me, which of these 10 rules surprised you the most? I read every single comment, and your responses help shape future videos. And if you know a family member, a parent, a grandparent, a neighbor, who is retired or about to retire, please share this video with them directly. It could be the most valuable thing you do for them today. Thank you for spending this time with me today. I know it's a lot of information, but you came here because you care about your future, and that matters. We'll be back soon with another update that you need to know about. Until then, protect your benefits, ask the hard questions, and remember, being informed is how you stay in control. Take care of yourselves. We'll see you in the next one.